Are you facing a potentially huge tax bill this year due to all of your earned and passive income? Well, if you guys hate paying taxes as much as I do, I've got an incredible tax loophole that you can use to not only write off hundreds of thousands of dollars of income, but get a ton of cool stuff and have your business pay for it all. Check it out.
You'll have equity in that deal, so whenever that property sells, you will get that original investment back.
Hey guys, welcome to Millionaire Mafia. Thanks for checking out our channel. Today I've got an awesome video for you. So we're going to be talking about one of my most favorite topics in the whole world, and that is taxes.
Say what?
So we're not talking about paying taxes. Nobody likes that. But we're talking about saving taxes. Not just saving taxes, but doing it legally and legitimately. At the end of the day, Uncle Sam gets us all right, death and taxes. However, there is nothing that states that we need to give any more than we should in taxes. And there's actually a really famous case that was headed by Judge Learned Ham of the U.S. Court of Appeals back in 1934. And he has this famous quote that I love and I keep on my wall. And it goes just like this. Judge Learned Ham said, "Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes." Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do right, for nobody owes any public duty to pay more than the law demands. Let that one sink in. No matter what you hear on TV, no matter what you read in the papers, hear on the radio, any politician that's out there who says, hey, people need to be paying their fair share, he's full of shit. We pay our fair share. But what he also probably realizes but doesn't tell you is that there's another side of that. And this is my favorite quote here. "The IRS code was written by smart, wealthy people to be bought and paid for by dumb, poor people." And the author of that quote is, well, me. I'm not the smartest guy in the world, but I know how to use the tax laws to my advantage. And today I'm going to show you a way that you can take very, very awesome, relatively new tax loophole that was created in 2017 and implemented in 2018 with President Trump's Tax Cuts and Jobs Act to allow for what is called bonus depreciation via IRS code section 179. So what we're going to do today is we're going to talk about what the code is, what it allows for, and then we're going to, at the end, talk about a specific example of how that can be used and applied to your business to not only write off a lot of taxes on your income side, which will essentially put a lot of money in your pocket, but to also gain assets out of that and then use other assets that you have to pay for that and essentially have no money out of pocket. So it's a pretty cool concept, and I'm going to show it to you right now. All right, so what is Section 179 of the IRS code? Well, what it is, it allows businesses to take an immediate deduction for business expenses related to depreciable assets such as equipment, vehicles, software, and stuff like that. Things like business vehicles, business computers, office equipment, machinery, off-the-shelf software that you would use in your business. Let's say Microsoft Word or Microsoft Suite or some other software that you put in your computer that you need, QuickBooks and desktop, whatever it is. And then horticultural structures, so things like pole barns that you store equipment in, barns in general, sheds, things like that. So those can all be used, and they all fall under IRS 179. This allows businesses to lower their current tax year liability rather than capitalizing an asset, depreciating it over time in future tax years. So we talked about what general things can be depreciated and fall under Section 179. So what are some things we got to think about? What are those business vehicles? Well, they're actually classified and broken down to be more easily understood. Now, bonus depreciation is going to be a lot more favorable to on the vehicle side for things that are obvious, work stuff, heavy equipment, heavy vehicles, things that trucks, big trucks, and big trailers, and cranes, and things like that are obviously only have for all intents and purposes have one purpose, which is to do work, right? Which could then be used for business. Not that you couldn't use it on a farm, on your own farm, and do stuff, but it's very obvious what their intent is. Their job is to work. It's not a pleasure thing, right? But we don't all need, we might have a business that we don't need a truck for, right? You might have a car that you use as a daily driver to get to and from. If you're a real estate agent, that you go to your showings and things like that, you don't need a big truck. You probably don't want one because you're wanting to keep your fuel economy low, because there's really no reason to pull anything. So one of the things that's in there is small vehicles. You can see there on the slide what is defined by a small vehicle. So you can't write off the entire amount for a small vehicle, but it's pretty good, up to $18,100. That's pretty good with bonus depreciation. Most small vehicles, now if you're going to get in a Benz or you're getting a Lamborghini to go do your showings and be that awesome realtor, wouldn't recommend that. But if you do, you're not going to be able to write off that full amount. So there's that. Now in this next slide, we talk about heavy vehicles. Now heavy vehicles is a truck. So any 250 or 2500 truck, and nowadays even a lot of the 150 or 1500 size trucks, what would be considered a small or light truck, would actually fit into this. So it's not only 6,000 pounds for the vehicle, but it's also a 6-foot bed or longer. So if you do that, you can actually write off the entire amount of that vehicle in the year in which you purchase it and put it into use. Now, put into use, what does that mean? Well, that means if you bought either the vehicle, let's say I wanted to order a 2020 vehicle and I bought and paid for it now. I put my deposit down, or maybe I paid in full right now in 2021. Well, if I don't get that until 2022, or if I buy a piece of equipment, even if I have it, if it comes to my office or it comes to my building that I'm going to use it, but I don't install it for use until 2022, I would have to then wait until 2022's tax return to file and use that towards 2022. So if I don't get the thing delivered, if it's not here in my possession being used and put into use, is what the IRS calls it, then it doesn't apply for that tax year. Not the end of the world, but if you're planning on ordering a vehicle and you want a new one, you want to use it for that current year, make sure you do that early. We all know how the supply chains and things like that are working right now. So there are some special rules when talking about IRS 179 that you're going to need to know about. It can't exceed your taxable income. So what I mean by this is if you have a business and at the end of the year, after all your expenses, you only show $50,000 in taxable income. Well, that's great because you're not going to pay a whole lot. You're going to be in the 18% or lower tax bracket. You might be in like the 10 or 12 or whatever it is, pretty low. But if you buy a $100,000 vehicle, you're more than welcome to do that. You can only write off $50,000. So in that instance, you're going to want to use what is called MACRS, which is the old and still in play format, which is the Modified Accelerated Cost Recovery System, MACRS. All that is where you basically take it over time. So each vehicle has a shelf life, each piece of equipment does, and it'll be depreciated that way. So you'll get a bigger chunk year one, and then it'll go down year 2, 3, 4 until essentially it gets down to nothing. So that's how the MACRS systems work, and their system works, and that's what you would use for that. One other really cool thing about the Tax Cuts and Job Act of 17 is that it used to be the bonus depreciation, or that depreciation was only used for new vehicles, not just new to you, like new vehicles. So what this allowed you to do now is that it doesn't have to be a 2021 or soon to be 2022 vehicle. It can be 2017, 15, whatever vehicle. It just has to be essentially new to you. And there are a couple specific definitions of what that is. And I'm just going to go ahead and read them to you really quick. In order for it to qualify the following cannot exist, meaning it has to not be one of the following. The taxpayer didn't use the property at any time before acquiring it. For example, if you have a lease on a vehicle, let's say you did a 5-year lease, and at the end of it, you're like, I can buy it for $50,000 and write the whole thing off. Well, no, you can't do that. You can buy a vehicle from that dealership, but you can't buy that vehicle because you did own it, even if you owned it through your business, right? Because you own the business, so you can't do that. So that's one. Making sure that you didn't acquire it from a related party, similar to kind of how the IRA investing works, where you can't, like if your mom owned it or your dad owned it, or your brother, like they can't sell you the vehicle and you'd be like, oh, I'm going to write it off, right? So it's kind of that you can't keep it. It's got to stay outside the family, right? And then the other thing is that the property can't be acquired in something that's like a tax-free transaction, like a light kind of exchange. So if you got property and it came with a vehicle in the property, right? Let's say I sold the property and I wanted to do a 1031 exchange. So I bought another property, did a like kind of exchange, and deferred my taxes, which is perfectly legal and legit and highly encouraged, at least while we still have this in place. On that property, let's say we bought a farm that we were going to rent out and operate and make a product, right? Well, if there was tractors and heavy equipment on that property and those all came inclusive of that acquisition, you can't then take that those pieces of equipment, those tractors, that heavy machinery, and then further depreciate that. You would have to do essentially a cost segregation study and do the entire property, which, the land would be excluded, and you'd have any structures and equipment and things like that would be taken into account with the cost seg. So that's the only exemptions to what you can't write off or to use bonus depreciation for. So here's another question that comes up, and this is a question that I had, and I was just like, poof. So I asked my CPA, I said, hey, Sean, okay, so that's cool. I understand that if I buy this thing, I can write the whole thing off as long as it's used for business, yada, yada, yada. What if I finance it? So for example, if I have a loan that covers the entire purchase of the vehicle, I have nothing out of pocket. I didn't actually pay anything, but I control it and I own it now, right? Can I still write that off? And he said, 100%. You can write off 100% of it using leverage. So whether you've got 50-50 leverage, whether you got 80% finance, you got to put any down payment or no down payment at all, you can write off 100% of that vehicle. And as you know, with the prices of vehicles and the cost of vehicles nowadays, that can be huge on huge implications, right? So definitely recommend leverage on cars, contrary to many financial, what I would call pundits, or, we won't get into that. That's just a whole other ball of wax. But anyway, I would not hesitate to leverage something there. And I'm going to use a specific example here in a little bit to show you why I really agree with leverage in this case, whereas in a lot of cases I wouldn't. So we've talked about what you can depreciate and how that depreciation works, and that you can also use leverage. Well, here's some other things that a lot of people have questions on. So I'm a pilot, flew 15 years for the Marine Corps, and I got a lot of buddies who fly. I got a lot of business owners who were military, and a lot of them were military aviators, and they're looking at buying planes. A lot of it will be to fly back and forth from events that they host or that they want to attend, go look at properties that are hundreds or thousands of miles away, but they also are going to use it for some pleasure. So they're going to go out, take their family out, have a good time, things like that, keep their currency, all that stuff. So they asked me, hey, can I do that? Well, first of all, I recommend them to their CPA, but the short answer is yes. There are some stipulations, and they're a little bit more gray with aviation versus the equipment. Like I said earlier, when you have heavy equipment like a tractor or a big trailer or a crane or something like that, like you're not using that for pleasure. Like it might be fun to play around in it, but you're not going out, taking your wife out to dinner on a John Deere, right? I mean, well, it is Florida, Alabama, so maybe, but you get what I'm saying, right? You go out in a plane, you take a Cessna, 310, you get a twin, 310, or you get a nice, Beechcraft or something like that, or a helicopter like I'm looking to buy. Stay tuned for that one in a week or so. That becomes a little bit of gray area. So what's that number? Well, the IRS kind of had a ruling after they came out with this to specify, because that became an issue. What they said was the taxpayer can deduct 100% of a plane's purchase price and maintenance expenses if the plane is used for non-recreational purposes or leased to a flight school. After the first year, to keep that deduction, however, the owner has to use the plane and show it they use the plane for at least 50% of the time for business-related expenses. Okay, so what does all that mean? Well, it doesn't mean that you have to lease it to a flight school, but for at least 50% of the time, you have to use it for business expenses. So if I put, in an aviation terms, a couple hundred hours for a private owner or even a small business, that's a lot of hours. So let's say we got 200 hours. I would have to fly that aircraft 100 hours at least doing business stuff, traveling to and from events, looking at a property several hundred or thousand miles away, whatever, going and doing stuff like that. And then I can use up to 100 hours of that flying around, just having a good time, going on vacations and things like that. Anything outside of that 50%, and again, that's where it becomes gray, and you want to be careful. You don't want to be shady, but there are instances where your business can be going out, borrowing the aircraft or loaning the aircraft or leasing the aircraft from you, the person, or the owner of the aircraft, and then you can write that off. So you can actually not only use that to add to those business hours, but also as an expensed out to whatever company that you own that is leasing the aircraft for use. Now, the business that is leasing it out will be using it probably for pleasure, but it's actually being leased out from the aircraft, the LLC, the entity that owns the aircraft, to the entity borrowing it. Therefore, it becomes a business expense. Now, if you lease it out to a flight school, that's cut and dry. That's easy, 100%. That's all business expense, right? And it can actually produce some income for you. Now, I realize most of us aren't going to be going out and buying an airplane due to the fact that they either don't like flying, don't want to fly, or just can't afford to fly it or have the time to do so. And that's fine. I just wanted to bring that up as an example because it applies to me and a lot of people that I know. So we talked about how you would use that bonus depreciation. So what are some situations, or when would you not want to use bonus depreciation? Well, we kind of already talked about one example, which is if you make $50,000 of taxable income and the thing you want to depreciate is worth or was $100,000. Well, you're not going to be able to write off $100,000 and have the IRS pay you $50,000, right, whatever $50,000 equates to, let's say 15 grand. They're not going to give you a check like a credit for 15 grand. You also can't, like you can do with real estate, with personal property, you can't transfer that depreciation to a subsequent year. So for example, you can't take 50,000 here and then shift 50,000 to the next year with the bonus depreciation. It has to be, you'd have to revert to a MACRS, which I believe, and correct me if I'm wrong, it's about 14.5% is the maximum amount year one. So it'd be about 14,500 on that 100,000, and then the rest would be, kind of spread out through the remaining years throughout the life of that asset. So you wouldn't actually negate that entire 50 grand. So you could buy something else. You could buy a couple vehicles or whatever, and that would work, but you just couldn't use the whole thing. So there's pros and cons. A couple things to note, even though it's pretty awesome that in 2017, unfortunately, starting in 2023, the Tax Cuts and Job Act is getting phased out. Specifically, the bonus depreciation, I should say, is getting phased out. So it's going to look like the following. So in 2023, it's going to go down. This is for tax year 2023. So really only 2 more years. It's going to go down to 80%. The following year, it goes down to 60%, and then another 20% down in 2025 to 40%, and then 2026, 20%, and then after 2026, there will be no more bonus depreciation, assuming no new laws are enacted or in that time or any extensions are applied. In 2027 tax year, it'll revert fully back to the MACRS. So that's just something to think about as you are looking forward. That bonus depreciation, we're always going to find loopholes and strategies to pay less in taxes, but that bonus depreciation option is going to go away. That 179 option is going to go away in a few years. So just be considering that and think about that, and consult with your tax professional, tax strategist. Now, right, we're getting long in the tooth. It's the end of Thanksgiving's next week in 2021. If you're going to buy something, you got to do it by the end of the year. Like I said, it's got to be in your possession, not just ordered. Okay. And not only in your possession, but put into use. Let's do a real world example to kind of show how awesome not only the bonus depreciation is, that's cool, but the real life application is how you can use an asset, a cash flowing asset that you already have, to pay for your new asset and keep all that money in your pocket. All right, so I'm going to run through a very specific example, and it's going to be my example. Why? Because this is the first year that I'm going to have to worry about potentially paying a decent amount in taxes due to the income I have. Now, the reason is because I sold a lot of properties this year. I typically don't sell properties, right? I buy them and hold them and rent them out. And so I do get income, but it's not a ton of income per property because I get it slowly over time. You do, 10, 15, 20 of those, and those all add up. But each property I get to depreciate and have property. And then through owning mobile home parks and RV parks and apartment complexes and storage facilities and an office, we can use that bonus depreciation. It's a little different with real property, and this isn't the scope of that, but it's still pretty good. I can usually write everything off and be at a negative or at a zero. And the nice thing about real property is that I can actually push some of that off to the subsequent years. Can't do that with personal property, which is what this section 179 is for. This particular year, let's just call it, I'm kind of rounding some numbers here to make things easy, but I'm going to have over $300,000 in taxable income. And that's even with hundreds of thousands, actually over millions of dollars worth of deductions that we have inside of our businesses that we have. So we have several businesses that own multiple different properties and different flipping businesses and holding businesses and things like that. So even with all that depreciation, I'm still going to have about $300,000 in taxable income. So it's awesome that I made over $300,000. That was after all my write-offs and everything, right? And I've had quite a bit. When you get over 300,000, it's actually I think 329,000. You're in the 32% tax bracket. So what does that mean? That means that every dollar I earn over that $329,000, I have to pay 32 cents on the dollar to Uncle Sam. I don't want to do that, and I don't think any of you guys do either. So we're going to say that I'm in the 32% tax bracket. What that means is that every dollar that I make and every dollar that I am able to subsequently write off is a 32% difference. So if I make $1, I have to pay 32 cents on that dollar to taxes. If I can write off $1, I save 32 cents on my taxes for every dollar I write off. So I am looking at the 2020 250 HD with that new badass 7.3 liter V8 10-speed automatic Godzilla motor. We can have a discussion about whether I should go with diesel or a gas burner. Trust me, for what I need it for, that's enough. And again, let's focus here. We're talking about taxes. 179 bonus depreciation. Let's stay focused, all right? Using bonus depreciation, I can write off $75,000 and I can write off 100% of it, right? We've already discussed that. At a 32% tax bracket, that's $24,000 in tax savings. Yeah, right? It's pretty awesome. But here's the best part. You don't have to pay cash to buy this property. I have a 100% LTC loan at 3% from my bank, and it's for 72 months. Now, that's a lot of money for a truck, and that's 100% leverage, right? And it comes out to $1,140 a month for the payment. I'm going to get a new truck, and I'm going to get it with 0% down, and I'm going to keep an extra $24,000 in my pocket to do whatever the hell I want to do with it. But wait a minute, there's more. My dad and I just finished another rental property. It's in the Pensacola area, and it's going to put another extra $1,200 in my pocket every month. I do own this one free and clear. So after all is said and done, I'm going to have an asset, my real property, the house, that's putting $1,200 into my pocket, and it's going to pay for another asset, my truck, and I'm not going to pay $24,000 to Uncle Sam. I mean, guys, this is why I tell people that people who pay cash and people who save are losers. And I don't mean that being derogatory. I don't mean that they're idiots and things like that. I don't mean that they're bad people. I just mean they're not being smart with their money. I am also not saying to leverage yourself to the hilt. The problem with finance is people get into two sides of just like anything in life, right? We're polarized. It's either you're all cash and you no debt any debt is evil, or hey, I'm gonna leverage all the way to the hilt. I'm gonna use credit cards to pay for everything, and then I'm gonna use a cash advance on that credit card to shift it to another one and have that card pay for that. Those are both stupid. They're both dumb. I'm gonna be black and white right there. They're both dumb. All right, the Dave Ramsey's and the Robert Kiyosaki's. I'm just gonna put it out there. They're dumb in their pure sense. Okay. There's a medium. Everybody works in this medium, right? Works in this middle ground. Some are a little bit less risk averse, some are a little bit more risk tolerant, okay? And then everybody else is kind of in the middle. And that's where you need to be. You need to find out where you fall in that spectrum. The only time you use debt is not on consumer debt. Now, a lot of people would argue that a vehicle is consumer debt. Yeah, but it's not when you use it with a business. And when you use an asset that your business already owns, holds, and operates to pay for that business asset. So that is the difference. It's not that it's using credit or using leverage is bad. It's that you have to make sure that you have other assets that are steady, income producing assets pay for other things, and use tax advantages to justify those purchases. If I paid cash for that vehicle, I would have $75,000 less in my pocket. If I bought it with myself and not with a business or use it as a business expense, I wouldn't have $24,000 extra dollars in my pocket. So I would essentially have to pay $100,000, 25 plus 24, 99, let's call it 100, $100,000. I would have had to earn $100,000 to buy a $75,000 truck. And then that $100,000 is essentially out of my hands. I can't do anything with it. This way, I can get a $75,000 truck, put $24,000 in my pocket, and have that $75,000 that I would have had to pay in cash and use it to buy a property that will make me another $1,000, $1,200 a month, and then pay for that truck all over again. Or I can buy another one next year and save another $25,000 in my taxes. Okay? This is why it's important. All right, guys, I hope you liked that video. I really had fun making this one. It's a little bit longer, I know, but man, the taxes is super important. It's huge. You gotta be familiar. And I'm not saying you gotta know the tax codes and all the laws to a T. That's why you hire a tax professional, or specifically a tax strategist. I talk about that in my video that I did on how to de-stress your business. I gave 4 awesome tips for how I took 99% of the stress and chaos out of my business and push that on to professionals who know what they're doing. Speaking of professionals, I'm not one. I buy real estate and I'm pretty damn good at it, but I am not a tax professional, a legal professional. I don't provide any type of representation or advice. This is just my experience and things that I'm familiar with based off of my knowledge and my investigation and my own research. Do your own research. If you have any questions about this stuff, I'm more than happy to answer general questions about what I do and what I think and all this stuff. But as far as the actual laws and codes, you got to reach out to your CPA, got to reach out to your tax professional, whoever that is, and your attorney for any type of legal stuff. All right, guys. Hope that helped you guys out in your business. Hope you can go find a new vehicle to buy and save yourself tons of money in taxes. If you like this video, please go ahead and subscribe. I've got a bunch of new stuff coming out here. I got some stuff on whole life insurance. I'm going to do a couple videos on me actually buying this vehicle that I talked about, because it's in the work. I'm going to go hopefully look at it this weekend when I'm down in Fort Myers on vacation and drive it back. All right, so we'll see how she goes. I really appreciate you guys being here. Hope you guys have a great Thanksgiving, and until next time, here's to your wealth.